Hang Seng is seeing gains of 0.6%. Taiwan is also seeing, quite a good move right now.
You're seeing a lot of volatility and uncertainty around global market.
The market regulator intends to phase out buyback through open market or exchange route.
53 points higher for the Nifty. The Sensex is up 180 points.
Market is as of now, in a consolidation phase. Valuations are rich.
We see a very good growth in the motor segment.
India just gets some indirect benefits, but directly, as you know, India doesn't get.
The Nifty, though, has given up its early morning gains, has moved into the red terrain.
I think the term cryptocurrency, private cryptocurrency, is a fashionable way of describing what is otherwise 100% speculative activity.
It's been a brutal year for tech giants around the world. Apple stock is down about 18% so far.
Patients or in general public is largely aware about their health.
115-point downtick on the Nifty, and that's almost a 300-point downtick that we are seeing from the top today. All right, that was the day so far. Quite a disappointing day for the bulls, and I guess a lot of people saw it coming perhaps because of the way global markets have shaped up, the COVID situation globally, and not just COVID in China, but the ramifications that it would have on manufacturing, on supply chain issues, eventually on travel demand as well. All of that has spooked global markets and our own markets. Hello and welcome to Closing Bell. I'm Sonia. With me, there's Nigel and Mangalam. Folks, it's been tricky, and today the mid-cap index is taking the biggest brunt, down over 330 points. The good part is at least some levels, 18,200, the recent low is something that's holding at least for now. But let's see, there's still 1 hour to go, and it's a massive sell-off that we're seeing in the market at the moment.
Well, that's right, Sonia. It's souring mood a little bit, right? Because you were hoping for a Santa Claus rally, but that's not really come about. But the hope is that we don't break down from here. However, bounces are getting sold into, and that's something that if you look at the last few days, well, we're moving to around that 18,300, 18,400 odd mark as well. But from higher levels, you're getting some supply. And just take a look at the options data today. The 18,400 call and the 18,300 call. There's a massive open interest built up at both these two strikes. So between both these two strikes, the total open interest build up is close to around 1.5 crore shares. That's massive, right? So aggressive writing is what we've seen at that level. And those that are writing the 18,300 odd call, the level that they are trying to defend is around 18,375 odd, because on average the premium would have been at approximately that level. Now on the downside, well, we're looking at two important levels. The 50 DMA, if things go wrong, well, you'll be hoping that that level holds out. And from the day's low, that's what we hit just around 35-40 minutes or so ago, 18,160, we have bounced close to around 80 points from there. So important for us to defend this level on a closing basis. The market's a little bit skittish. Maybe these worries that we're having right now, maybe it's getting blown a little bit to an extreme as we speak. Maybe things will not get that bad. So that's a crucial zone. The bulls will be hoping that this level holds out. Mangalam, what else?
That's right, Nigel, history rhymes, but let's hope that this time around it does not repeat because of the way we're seeing these moves on the stocks that we're talking about out here. Anything which has to do with going outdoors is getting pummeled. Case in point, something like in Indian hotels, we have PVR, we have Trent, we have Lemon Tree hotels, all of them under pressure. The mid-cap index is a telling sign because over the last few trading sessions, it has been underperforming. Today, for the most part of today's trading session, it was actually doing well, the first half at least. And then there was this tug of war between bulls and bears. If you just take a look at the crisscross lines, you'll see that, the mid-caps were advancing for most part of the first half. Then those lines came together, and thereafter there was a bit of an intersection. And now as we speak, we have nearly 2,500 stocks which are declining, and that compares with just around 450 stocks which are advancing. These lines are at the furthest that they are, with the green line being way below the red line as we speak. And a lot of these F&O stocks, they're getting pummeled. We have IRB Infra down 6%, Adani Group stocks, all of them are lower by almost 5 to 6 odd percent. Anywhere there was some movement over the last few trading sessions, we've seen those stocks underperform. India Bulls Housing Finance, for instance, down 5%. City Union Bank has been under pressure all through the day, is down by 5% as well. There has been a return of the VIX. The India VIX is up almost 12 odd percent. So that is something we're watching. It's back above that 15 mark after a spate of few months of being very low and being very benign around that 11, 12. So that is something we'll keep an eye out on as well. And just as we speak, you spoke about the high call writing, Nigel, at 18,300 and 18,400. What that has done is that it's taken the put call ratio, the live put call ratio, to 0.68. What happens tomorrow will be extremely crucial because it's also the weekly options expiry.
Yes, absolutely. Thanks a lot for that. So, that's of course what's happening with the markets right now. But there's a fresh COVID spurt, as we told you, in China, Japan, and the US has also been ringing those alarm bells. Our own government has put out a statement as well. We have the health minister who spoke about how, in the view of rising cases, they've reviewed the situation with experts and officials today, and they have directed all concerned to be alert and strengthen surveillance. So I guess that will be, the topic of discussion over the next many days on how to sort of get back protocols, whether it's restrictions, whether it's masking up, the RT-PCR tests, etc. So we'll keep you posted on that. For now, equity markets are selling off. Let's tell you what's lined up on the show. Indian markets at the day's lows as COVID worries resurface. We'll track the market technicals with Rahul Sharma of GM Financial Services. Diagnostic chains gain after resurgence in COVID cases globally. Dr. Lal, Path Labs, Metropolis Health and Vijaya Diagnostics gain about 4 to 8%. More details coming up on the show. And Glenmark Pharma is surging on the back of an important drug launch for the diabetic treatment. Details lined up on the show. We'll also be joined by our alpha manager Ronak Onkar of PPFAS Mutual Fund to discuss his top 4 portfolio bets.
All right, how do you position yourself, though, for the final hour of trade? Mitesh Thakkar joins us to tell us exactly that. Well, Mitesh, we've recovered 90 points actually from the low point of the day. What's your sense? Could we see a pullback from these levels? Things are pretty much uncertain right now. But what are the stop losses you're working with, and will you take a fresh trade?
Nigel, we've done a couple of things. One, I think in the last 4 days, the market has been very choppy, but rallies have failed to sustain, and we've kept coming back to levels below 18,300 to 50 levels. Today, I think what could happen is that the 10-day average and the 20-day exponential average, I think they could record a negative crossover. Last time we got a buy around 17,200. Now we're getting a negative crossover, which should suggest that there should be slight more downward pressure, and the indicator setup is also negative. So I think selling into call options could be a good idea. Selling the 18,500, 18,400 calls is what I would recommend. And that about, I think, on the stock side, pharma is a sector which is broken out. So taking long in pharma, trying to identify short opportunities in the index as well as other stocks is what I think traders should look at. And on the pharma names, I have a buy on Cipla. Keep a stop below levels of 1104, look for targets of 1165. And Apollo Hospital, not exactly a pharma, but a healthcare name, that's also breaking out. That's a buy with a stop below 4720 for targets of 4850.
All right, Mitesh, just as we spoke, I had this handy list which I would track about a year and a half ago. And it's the end of 2022, I thought that maybe this list would never come back, but I had to pull it again. And this is basically the gainers and losers, at a time when COVID cases are rising or falling. And it's telling something that it's just fears right now. If you just take a look at the top gainers on the index, we have Glenmark Pharma, rather on the pharmaceutical index, we have Glenmark Pharma, Metropolis Health, Granules, Divi, Cipla, all of them gaining anywhere between 4 to 7 odd percent. In the F&O space, we have the losers, which are anything to do with people moving out, mobility stocks, which again, this is a list that was handy from the last time we had faced such fears. Indian Hotels lower, Delta Corp is lower, PVR is lower, Trent as well. Even in the cash stocks, we have big gainers like IOL Chemical, Solara Active, Dr. Lal, Thyrocare, which has now spiked to the high point of trade. And, concomitantly, the losers include the likes of Lemon Tree Hotels, Wonderla Holidays, specialty restaurants. What has changed from then to now? Well, we are better capable of handling such situations. Secondly, these are just fears, so this is not matched by any sort of increase in cases or severity or any sort of data that has come in to prove that, this time it is different. And thirdly, this is also the time where, there has been a rush of travel and people actually going outdoor for a normal celebration after 2 years. So fundamentally, things are very different. Fears are, taking the stock prices lower. So the question is whether it's exaggerated or not. We do have Ekta with us as well. Ekta, you've been, working the phone lines. You've been speaking with a lot of diagnostic players yourself. And the health minister, too, held a meeting with COVID experts today in light of the rising cases. What have you picked up?
Well, overall, yes, the diagnostic companies are buzzing today simply because there is hopes that maybe testing could probably increase in case there is a rise in terms of COVID-19 cases. The alarm bells are probably sounding a little bit simply because of the rising cases that we have seen globally. But in terms of the feedback that I am picking up with the diagnostic companies that I spoke to, they said that currently it is absolutely insignificant in terms of testing. There is no real change in the curve which is expected as of now. Now, according to them, based on the trends that they've seen in the past, where even in the earlier COVID, in the previous COVID cycles which had taken place just some time ago, what tended to happen was that there was more home testing as compared to PCR testing in the lab, and that trend is probably going to continue as well unless there is hospitalizations as well as severity of the cases rising. In that case, yes, volumes when it comes to diagnostic labs could pick up. But how much, considering that there is a lot of competition which has already taken place in terms of the diagnostic space? So are you going to see heady volumes that you saw earlier, right at the start of COVID? Unlikely for it to happen again. And hence, while you are seeing gains, as of now, the volumes in terms of COVID-19 testing is one, going to depend on hospitalizations, two, severity of COVID-19 as a whole, and three, what the competition dynamics look like at that point in time. Already for COVID-19 testing, if you just look at the Q2 numbers, they've fallen anywhere between 80 to even almost close to 100% for a lot of these diagnostic labs. It was the lowest ever in terms of COVID-19 testing in the previous quarter. So you can probably not expect a huge, significant upside from those levels based on the situation that we're talking about today. Valuation-wise, yes, there's been a correction to in terms of a lot of these stocks, but the valuations on an FY24 basis still look quite punchy.
Okay, thanks a lot, Ekta, for that. It's important to point out here that, one must not spread any panic right now. Of course, it's important to be proactive, but don't panic. And the government has said in as many words that they have enough and more resources to deal with the pandemic and the situation if it goes out of hand. And as of now, the government has asked several states to set up surveillance for variants to detect whether variants of coronavirus, new variants, have reached India or not. But market expert Prakash Diwan is joining us in. Prakash, generally, there's a fear that grips the markets when these kind of COVID situations erupt. And this time, at least as per reports, the situation in China is quite grim. From a market investor standpoint, what do you do now?
Good afternoon, Sonia. So, essentially, what China is facing is probably an issue that is still, I would say, encompassed with its own limitations. I mean, this is a fallout of a very weak vaccination program. The vaccines have not been effective, and hence they've always been struggling to keep a lid on whatever COVID cases were expanding. Now, if that were to spread beyond China is the big worry, and that's a big if. And my sense is if the variants are not newer than what we already kind of got familiar with and have handled and tackled those, I don't think that we need to, really worry. But the market was so overweighty in terms of valuations earlier that, this was a very perfect trigger of sorts for some sort of a sell-off. And in the absence of any fresh buying globally or from, FIs, I think, the market probably gave itself to this thing. But the real capitulation is something which will only happen when you have empirical evidence. And as you rightly said, there's no need to panic either in the market or on the health front. I think we will probably be in a better position to handle this as things get much more clearer. So as an investor, if you have a wish list of things to buy, which is beyond what Mangalam's wish list carried, which is more momentum driven, short term, immediate term, for the long term businesses that are resilient enough and you will get them at softer valuations, you need to go ahead and buy. It's as simple as that. These are days when you need to revisit your buying list or your shopping list and orient that towards your portfolio allocations. There's nothing better than this at this moment. And remember one thing, what is happening in China, if that were to actually grow within China, there's a huge supply chain disruption that could get triggered globally. And we could benefit from a lot of things that we probably do, and the China Plus gets only much more sharper. So there could be some flip side, benefits on the flip side as well. So don't worry about markets as much. Just look at what you need to buy or what capital you need to allocate at this point in time.
Okay, all right. Well, Ekta is well soothing our nerves out there. She's saying it's not a case to worry as of now. And Prakash saying if in case, the hope is that things don't get that bad. it could actually be providing an entry opportunity in some of these stocks. So Prakash, on that note, if you have hotel stocks are under pressure, Delta Corp as well is lower, some of these aviation companies as well. From this entire unlock trade, which today is under pressure, which ones would be your pick?
Nigel, that's exactly what I'm saying. So I have, let's say, X number of stocks in my portfolio, and if most of them happen to be resilient enough in the long term or the medium term, I would just need to keep on adding to it. But out of these specific sectors or segments that are more directly COVID correlated, I would believe aviation, for instance, might get impacted from a sentiment perspective. But the way Indigo flights are carrying, to full capacity, the way people still want to travel, and they've managed the COVID tough times very brilliantly. So I don't think there would be another fallout where it will start impacting the business. But this is something which is like a blip, and once things resume, it could only get better. So I would definitely buy into the ones that are down today, but keep away from those labs and those diagnostic companies. They're so richly valued. And it's not going to be the same again, even if things were to kind of be a bit sour from the COVID perspective. So let's not kind of start extrapolating that Dr. Lal Path Labs could do 10% better margins or better revenue from here on just because of this news. So I would stay away from all the positively driven momentum stocks, but buy into the likes of Indigo and Indian Hotel because they're far more resilient, even in the medium to long term.
Point taken, Prakash. Sticking with the consumption theme itself, I'm not sure whether you followed this story or not. Yesterday, Jubilant FoodWorks actually announced that they will deliver pizzas in 20 minutes. That's breaking the 30-minute barrier right now, as anyway 50% of their orders were delivered in 20 minutes. Now they've cast that in a campaign itself. Do you think that would be enough for the company to actually go ahead and grow their core business? Because up until now the street was pinning their hopes on their ancillary business to drive growth, but now with this 30 coming down to 20, this could change the game for them.
So Magnum, you know this so well. Nothing sells as well as pizzas do, right? Whether it's donuts or biryani. End of the day, you want to call up the hunger helpline because you actually crave for that pizza. And the best part about this 20-minute innovation is it does not leave people with much of time to think in terms of what else they could order. And remember, pizzas were not competing against another pizza supplier. They were competing against alternative foods. And with this timeline coming down, it becomes at par with a lot of the other delivery mechanisms that exist from other nearby eateries, right? So from that perspective, I think they will definitely see a swing, and there will be a little bit of an improvement in revenue for sure. If it sustains as an improvement in market share in terms of the entire food share, then of course, it will translate into profitability as well, is my guess. But I'm sure this is definitely going to work out. And then the target of touching that 2,000 mark in terms of a store network is phenomenally very well designed, because it covers the most productive or the most profitable locations in the country. I mean, it's almost like 80-85% of revenue generator segment. So that's what's going to be a big change. But yeah, you'll have to give it time for these strategies to be implemented. But I'm quite positive it could work for them.
One of the things the CEO said to me, the global CEO said to me, is that they're slow when it matters and fast when it counts. So we have to give them time, and the time that they will give us then is 20 minutes. Prakash, just hang in there. We'll take a short break, come back, and we also discuss the market technicals.
Welcome back. We're up a good 100 points from the low point of the day, so that's pretty good news. And a couple of stocks actually from the broader markets as well are doing pretty well. So let's pull up the intraday chart of India Bulls Housing Finance. Remember, that was moving with good momentum. Suddenly the markets got a little bit rocky, and that saw a sharp correction. But from the lows of the day, it's up close to around 4%. Balrampur Chini, that's the other one that was down. That's pulled back a goodish bit. And even some of these other names like Delta Corp as well as Indian Hotels, both of them have seen a bit of a pullback as we speak. But the biggest gainer from the F&O stocks is Glenmark Pharma. Well, they have an important drug launch for diabetes. Ekta is back with us to run us through details on that front. Ekta?
Thanks for that. Well, yes, Glenmark is in focus because, they have launched a triple fixed dose combination drug, which is basically used to treat diabetes. in the Indian market. Now, the three components of this triple fixed dose combination drug, which basically means that there are three ingredients in this particular one tablet that they have launched, includes teneligliptin, pioglitazone, as well as metformin. Now, the drug, like I mentioned, is used to treat type 2 diabetes as well as high insulin resistance. It is launched under the brand name Zeta Piomet. Now, remember that Glenmark is probably seeing traction on account of this is because it is one of the first companies to launch this particular triple FDC or triple component fixed dose combination drug in the Indian market, and hence it could probably have first mover advantage. The diabetes market in India is close to around 12,000 odd crores. The growth of the oral diabetes market is around 6.3%, and hence there is some optimism with regards to that. The company has also been very active when it comes to launching diabetes drugs. They have launched multiple diabetes drugs since 2015. This would be the latest launch, possibly with first mover advantage, and that's why you're probably seeing traction on this stock today.
Okay, got it. All right, Ekta, thanks a lot for that. Ekta is the only one that's bringing us, stocks that are in the green today. Well, Prakash, what do you think about this one? Glenmark Pharma, 7.5% higher as we speak.
Yeah. So, I believe it's just, something good coming out of a company that has probably been very slow in terms of a catch-up on not just valuation, but on a lot of operational metrics. So I think the market's celebrating some sort of a, promise that's emerged from the FTC on the diabetes, anti-diabetes drug. But, Glenmark has a lot of other areas that it needs to pull up its stocks on, is my guess, from a company perspective. And there's so many better opportunities in terms of scale and size and product mix that you would look at. I mean, I don't see any reason why a Cipla can't be in a portfolio if you have to allocate money to a larger pharma name. So, or a Sun Pharma with its, growing portfolio of specialty drugs. So, yeah, I mean, this news is positive, but it is probably just a respite to a otherwise beleaguered stock. It hasn't delivered much, and I don't expect it could probably sustain too much beyond just a few days of this momentum.
Well, look at the market, volatile and pretty much all over the place right now. The Nifty low was 18,160 and we're over 100 points from the day's low. So I guess that Christmas carol singing worked a little bit.
This morning.
I was feeling like, you know what, I mean, we started on a bang and look where we are, but not bad. At least we're off the day's lows. And the important bit is that we shouldn't panic, right? Yeah. I mean, this, of course, this is headline grabbing, the COVID situation in China, but we know better than that. And we know that as of now, there's nothing that's happened. Of course, protocols need to be put in place, but there's no panic needed.
You sang a couple of lines for us in the morning. You want to go for a couple more?
I don't even know which ones. I know a couple of them. Golden words cannot be repeated.
All right. So you hit it out of the park.
Okay, but I mean, it's just a couple of days before we head into Christmas, and Nigel's off for his Christmas break. So maybe you want to sing those carols for us,
not
right?
as yet. Let's hope if the markets recover a little bit more, I'm sure Mangala and me will put something together.
Later in the evening, perhaps. But Prakash, tell us a little bit about, a couple of these stocks that have been in the news, right? So you had City Union Bank, and I was speaking to a fund manager just a while back from Edelweiss. In fact, Edelweiss has City Union Bank in their mid-cap fund. And I spoke to him about how when these things emerge, like an RBI divergence, for example, it spooks the stock a little bit. But do fund managers, actually exit at times like this, or do you keep the faith? And he said, in the longer term, all of this really doesn't matter. I mean, you stick with the stock and you monitor it, and you just sort of keep the faith. Would you agree with that?
So, Sonia, it's a tough call for somebody who owns the stock. It's very clear for somebody who is looking at the stock to buy, and that very clearly means you'll get it at lower valuations. But, at times what happens is you really don't know how long is it going to be, long drawn this, remediation is going to be for whatever divergence has been spotted or reported. And that could probably, mean that you would have to wait much longer than what your investors or what your, co-investors might want to. So that's a problem. Otherwise, I think, yes, I do agree in the long run, fundamentals of the business are far more longer term, far more impactful than just a little bit of a sliver of a divergence on certain things. But it's RBI, it's a regulators, knock on the knuckles. It's not something which you can take very lightly as well. So I would stay away from the stock for the time being for sure.
Okay, stay away from the stock for the time being. We have Rahul Sharma that's up next. So let's get straight to him. He's the head of technicals and derivatives at JM Financial Services. Rahul, welcome to the show and greetings of the season to you and your entire team at JM Financial. Do you think this market is headed lower? For now, at least the 18,200 level is being held on the downside. But do you think it's a matter of time before it gets taken out? And what's the slightly medium-term strategy over the next couple of months on the Nifty chart looking like?
Yeah, so the important data to keep an eye on today is the put-call ratio. The options positioning has become extremely bearish, extremely pessimistic. So the Nifty put-call ratio is trading at 0.69, down 32%. The Bank Nifty put-call ratio is at 0.53, which is down around 42%. Now, if historical data is anything to go by, the data is screaming buy. But given the global situation, we have dealt such scenarios in the past. We've seen a lethal second wave, we've seen a third wave, which was not so lethal, and markets came out relatively unscathed. I think this is a good opportunity to keep an eye on levels. Now, 3-point mantra, mantra number one, avoid the COVID sensitives. It could swing both ways, whether you are right or wrong. Data from China is pretty much not so reliable, so it could swing on the other side as well. So avoid chasing COVID sensitives. Second is keep an eye on levels. Nifty 18,130 and 17,900. These are the two important technical support levels to add longs in this volatility and have a positional view where we believe this is still a buy on dip market and these corrections are to be utilized as buying opportunities. Mantra 3, avoid leverage positions until and unless 18,500 is not reclaimed. So I think these are the three key levels to keep an eye on. Once 18,500 is navigated safely, we can very well come back to leverage positions and the aggression can go up. But otherwise, I think it's best to be a buy on dip kind of an investor, keeping these levels in mind. And we still believe that this is the medium-term outlook of the market is still positive. We could very well see the Nifty heading northwards, possibly in a few weeks' time.
All right, Rahul, that is sane advice coming in. So just watch out for levels and then take your trades accordingly. You said that one has to avoid COVID sensitives. Where would you put pharmaceuticals in that list? Because while we're seeing diagnostics move today, you can call that a COVID sensitive, but a couple of these pharmaceutical stocks are actually buzzing around, and COVID, sort of fears have only given it some tailwind. So case in point, Glenmark Pharma, Ekta spoke about them actually launching a drug which has to do with diabetes. So it's got fundamental news. Volumes are picking up. Would you say that on the charts, pharmaceutical stocks are looking attractive, or maybe just avoid these as well?
Yeah, so Magalam, stock-specific activity can continue in pharmaceutical names, but broadly as a sector, I would stay away from it. Primarily going by the hint, going by the input that the rising COVID cases could be a positive. In fact, a lot of APIs come to India from China, so I don't think so how it will be beneficial if the local situation in China is not so great. So it's best to stay away from that sector. In fact, some of these sectors which are relatively much better, I would focus my eyes on the PSE index, on private banks, as well as cement to a great extent. I think these are sectors which are relatively not so affected by what is happening at a global level. And we would stick our neck out and say, be ready with your cash to deploy at low levels in some of these names. And pharma sector, I think it's best avoided given what the kind of performance that we saw the last time we had a scary situation domestically as far as COVID was concerned.
Okay, hi Rahul. Things are swinging around actually. We pulled back 100 points. In the last 10 minutes, we've given up half of that. We're up close to around 50 points in the day's low. But you're clear, keep allocating money, and you believe that this is in buy on dips mode. When does that get nullified? What is the stop loss you're looking at on the downside? That will make you change this view.
Yeah, so as far as levels are concerned, I think 17,900 is a good level to go fishing. If the view has to get negated, technically the setup will get disrupted if 17,500 on the Nifty gets broken. Unless and until that happens, we still believe that this is, we saw almost like a 2,200 point kind of a rally. This is just a pullback which we are continuing. So as a stop loss, I think as an exit strategy, 17,500 should be a good level. If it closes below that, the view gets negated. Until else, we can continue with the buy on dip strategy.
Hearing your thoughts, Rahul. Thanks so much for stopping by. Markets are in a bit of panic mode. We wanted some kind of levels, and you joined us and you obliged. Thank you so much. Wishing you a good evening, and in case we don't speak till Christmas, wishing you a Merry Christmas as well.
Wish you the same.
Well, on that note, though, we'll slip into a short break. But as always, on the other side, our technical experts will be back with us We'll also be joined by Alpha Manager of the Day, Ronak Onkar of PPFAS Mutual Fund.
We're falling once again, and that is something that has been the trend of today's trading session. Every time there is a bit of an attempted bounce back that gets sold into as well. Now we're back closer to that 18,200 mark, and just moments ago we were a little over that 18,250 as well. So it is all over the place. We are seeing a fair amount of volatility. So long as it stays in the range, the street would be happy, but right now it is choppiness all over, which is of course reflected in the way the India VIX has moved as well, now closer to the high point of trade for that fear index too. So let's get in our alpha manager of the day, long-term focused on equities itself. We have Ronak Onkar, who's the fund manager and head of research at Parag Parikh PPFAS Mutual Fund. Ronak, I was looking at your top holdings across the two portfolios that you have, and none of them have any healthcare diagnostic holdings or any stocks, no exposure there. Do you think right now is a time maybe, or you continue to focus on the stocks that you hold, believe that these are just volatile moves and it's best avoided?
Hi, thank you for inviting me. So I think in healthcare, our strategy has been very clear to build a basket of generic export-oriented pharma businesses, which have a better balance sheet, have exposure to international markets and a diversified portfolio. In diagnostics, although the sector we track quite closely, the valuations have never been that attractive, and the listings also have been very recent. So I think giving a time frame, which is say pre-COVID and now, the business has actually performed very well, and the valuations have also caught up to that. So I will wait for a good entry point in these companies, but we keep tracking them. These are interesting businesses with great growth opportunities in the country.
Hi Ronak, you'll have various funds out there with different allocation as well. At this juncture, given the kind of valuation on equities, given the hawkish commentary we're getting from the central banks, and now suddenly this resurgence of COVID in parts of the world, what would your advice be? Would you advise, investors to put more money into, say, more debt-oriented funds, or will you go still for the equity funds?
Actually, it's a great time to look at your asset allocation overall. If you're an investor who has been invested in equities as a larger chunk of their net worth, you can actually look at debt allocation where even short-term to longer-term debt, you're actually finding good opportunities and getting decent returns, which otherwise you wouldn't get in the past couple of years. These things have been changing over a period of time. Whereas from asset allocation point of view, if equity or longer-term investing is your requirement, then equity remains to be a good asset class to consider and keep investing in. From a portfolio point of view, I would say that we have around 13% of cash in the FlexiCap fund, which has not changed dramatically. Over the past few months, we have been having a cash position, but it's not because we are hoping for a macro event or a market crash or something like that. It's mainly because the opportunities in our domestic market are not plentiful in terms of deploying capital. So our existing portfolio keeps getting some of the incremental capital that we have in the fund, where we find good ideas. The only new stock we've added is the UTI Asset Management. But beyond that, I don't think there is a very attractive valuation of any company where we think we can add immediately.
Okay. In fact, we do have, some of your funds on the screen, so we'll get them on board. You have the Parag Parikh Tax Saver Fund as well as the Parag Parikh FlexiCap Fund. And I do notice that you still have some large cap IT players in your list, whether it's HCL Tech, Tata Consultancy, in your Tax Saver Fund. Now, if you look at Accenture's recent commentary, they spoke about how there's rising caution amongst a lot of their clients. Clients are sort of focusing on cost optimization, smaller deals are getting cancelled. Would you still keep the faith here with some of these large cap IT names, or do you think it's time to churn out now?
So with IT services as a sector as a whole, large cap or small cap or mid cap companies combined, if you see the demand is also cyclical. It doesn't happen that you have consistently great demand. In the last couple of years, we have seen many people accelerating their technology budgets because the other incremental capital allocation was not happening anywhere, and people thought maybe transformative deals could be done when you have to work remotely, other employees and offices across the world have to be connected. So IT services spend was disproportionately higher compared to past years. But this is a cyclical business. We don't have to forget that. And we need to understand that as companies scale their budgets again from smaller deals to larger deals, that cycle will turn around. The whole idea behind IT services businesses, they have steady client base. Some of the businesses, bread and butter, regular business where you have to provide IT services. And from a cost optimization point of view, it actually helps people to offshore work to low-cost areas like India, which is the business model of IT companies. Over a long period of time, this trend has been working very well. There will be cyclical blips. There will be issues where some sectors will not do well. And we have seen this in the past. So it's not something new for IT industry as a whole.
Ronak, in both your FlexiCap and the tax saver fund, I do see a fair amount of financials. You have ICICI Bank, you have HDFC Limited, Axis Bank, and I also see a lot of PSUs. You have Power Grid and Coal India. What would you think of PSU financials? I mean, PSU banks were on a tear. Do you think this is a good time to get in, given that everyone's structurally bullish on financials?
So from a financial investments point of view, we thought that private sector banks are a good place to be in because these are faster growing, better consumer franchises. In PSU category, we have not chosen to invest in the financial sector. However, on the other PSU side, which you mentioned, there are a lot of good companies in the PSU space which have been run very well. And I think they have been beaten down quite unfairly in the past several years. And some of the stocks were very attractive with great cash flow generation and also good dividend yields. So some of these companies are attractive from that point of view. But however, PSU banks will not find a place in the portfolio at this point.
Ronak, IRFC, I think you had some, y'all had got in early, right, out there. Now there's suddenly renewed talk of maybe a potential divestment. At this juncture, the stock is down more than 10%. But are you all still constructive on the stock? Will you allocate more money?
So IRFC is not part of our other equity schemes. It is only part of the conservative hybrid scheme, and that too in a very small portion. The idea behind conservative hybrid scheme is to have some equity which has high dividend yielding potential to the business. So IRFC was a part of that portfolio. But it's a business which has the same characteristics of any PSU business, and the divestment theme has been going on for a while. It remains to be seen how it plays out across several PSU companies. We look forward to seeing some divestments happen.
Okay, all right. Just a couple of more stocks, right? I mean, if you look at how the year has shaped up, one of the best performers this year has been ITC, and that's a part of your portfolio in both your FlexiCap as well as your tax saver fund. Now, do you think that the best performers of last year can do an encore this year? Or is the outperformance, going to be restricted to just 2022? What's your best guess?
So hard to guess how the performance is going to be going ahead. The reason why we bought ITC was actually the valuations compared to other consumer businesses. The cash flow profile and the capital allocation changes that they announced, it seemed like a good idea to buy at that valuation. We have not added to ITC in the recent past. The stock has run up quite a bit. But it's not at a point where it has become very expensive and it needs to be sold. It's a very interesting business, continues to generate the cash flow that they generate, and continues to also improve the share of profits from the consumer space, which is a non-cigarette space. So we keep a watch on it. Anyway, we don't buy and sell ideas based on shorter term trends. It's a longer term hold for us, and it's a good capital allocate.
Okay, Ronak, we leave it at that. Thanks a lot for stopping by and speaking to CNBC-TV18. Well, that's PPFAS Mutual Fund with their view on the way forward for the market and how you should approach the new year. We have 15 minutes to go before the day comes to an end. Give and take everything, very volatile day. Yes, we recovered from the lows, but it's also a day that belongs to the bulls. And we've once again seen a sell-off in the last 10-15 minutes of trade. So it's advantage bears today. Sorry, the day belongs to the bears squarely. Mitesh Thakkar joins in to tell us what to buy or sell today for a reverse trade tomorrow. Mitesh, first at 18,200, do you think this level can be breached in the near term, or do you think it could be held? And also, what are the stocks to watch now?
So I think there is a good chance of actually, us going much lower purely because of two reasons. One, I think the Nifty, as I said earlier, the 10-day and the 21-day average are crossing on the negative side, and the back Nifty is now trading below this 42,900, 850 zone, which was a support pivot. So with both the indices under pressure, I think the logical move should be happening on the downside. The Nifty, we would look at targets of around 18,100 or possibly in the worst case scenario, even 17,950, 970 zones can be tested. So still negative. And on the stock side, my belief is that this long pharma, short other stocks, I think that kind of trade continues. So Bharti Airtel is something which traders can look at possibly, taking some kind of a STBT kind of position, keep a stop at about 820, look for targets of 804. While on the long side, Aurobindo Pharma is in BTST with a stop below 449 for targets of 460.
Okay, all right. Mitesh, stay with us. We have just around 16 minutes till we wind down. For the time being, let's get in Neeraj Diwan, Director at Quantum Securities, who joins in. Hi, Neeraj. Good afternoon. Thanks so much for joining in. Well, Mitesh technically is saying that some of these pharma stocks are looking good for more. I'm just trying to see a couple of stocks that have done well in the last 1 hour. You have AMI Organics. That stock has spiked up, moved to the high point of the day as we speak. Let's get the intraday chart out there. Neeraj, by any chance, do you track this one, AMI Organics?
Yeah, good afternoon. No, I don't track AMI Organics,
okay.
The pharma stock. No.
All right. What about these pharma stocks? Some of them are coming out of a multi-month, some of them multi-year underperformance actually. You have Divi's that's up. I think it's bounced closer from its 52-week lows. Strides as well has been a big value destructing stock actually in the last few years. Any of these stocks will you look to buy into?
I think Divi's is one stock where, you even getting some sense that, again, their businesses which they were earlier focused on totally on COVID, now they're coming back to therapeutics and their traditional stuff that they were doing before. I think the consolidation that we saw in the business and the stock price, I think should be over for the time being. So today, I think COVID fear that, that is coming again, or the talk about COVID. So this move may be associated to that, but even if you keep that aside, I think we've seen a consolidation and the businesses over the next 2-3 quarters should start again the growth perspective, and a movement should happen there. And especially on this healthcare pharma, I would say that I would go for something like a Fortis Hospital maybe, because what you need to see today is that you need to get into a stock where the valuation is also attractive. So valuation wise also that is decently placed. So whether it's the movement is happening right now because of COVID, or whether it's not because of COVID also, the stock generally should do well because we've seen the profitability and the margin improving, and valuation remains under check because of whatever is happening with the takeover and the new management. So I think that is why it's still available at a decent valuation.
Okay. Neeraj, COVID or no COVID, right? I mean, if this market dips, it's a great opportunity for long-term investors to perhaps buy those stocks that they didn't get in the rally. So if you look at the big performers this year, there are names like M&M, Axis Bank, SBI, Adani Enterprises, of course, big move over there. Would you buy any of the gainers of 2023 in the dip, gainers of 2022 in the dip if it comes about?
Yeah, absolutely. We need to right now keep to our strategy of the stock which have been doing well and the investment theme which have been doing well. One big name that you mentioned is Mahindra & Mahindra. So in auto, this is done very well, and plus even now you don't find it at a very absurd valuation. Valuation is still very attractive looking at the return ratios. So I think for investment, Mahindra & Mahindra would be in that category. And there are other themes which played very well this year. There's a defense theme where so much is happening in the defense. So many orders are coming. Order books are huge, and so much is going to be spent. Make in India, what is happening. So that will continue doing well. So if you get these stocks in this dip, I think defense would be another good pick there. And even in the financial, I think right now maybe you can see what kind of dip happens. This correction which is happening generally because of market being at a high level, because of market being overbought, and because of this COVID talk. So you may get some correction there also. So you right now look at the strongest stocks, whether it's HDFC, ICICI Bank or State Bank, and there if you get some opportunities because of this dip, even that's a good theme one should look at. Because and then the fourth thing would be infrastructure capital good, where we saw the capex is picking up. So infrastructure capital good is one space where I think there are opportunities, and with this correction, I think you can look at opportunities there also.
Right. Neeraj, you spoke about auto, and one of the stocks which can be considered a quasi auto ancillary is Kansai Nerolac. It's up 4% right now. In fact, in an otherwise very weak, wobbly market, especially for the broader markets, Kansai Nerolac, the intraday chart comes up for you up around 4%. And with huge volumes as well, 2 times what we've seen on an average on this counter. But something's off, because not all other paint companies are moving as well. But this may have some sort of valuation support, and if the auto cycle turns and we get greater demand, people will look at this. Your thoughts on this one, if you track it?
Yeah, actually, there are two things, like you mentioned about autos. If the demand continues and the numbers are supportive, and there's no dip which comes because of some COVID scare which can come or which may or may not come, it's too early to say. But valuation-wise, also this, as compared to others, this is a little better placed, and plus autos valuation and crude prices. So crude prices also hovering around 80, and there's a chance that they may come down from these levels. So all these things are supportive, and so Kenza Nerolac, there I think it has these 2-3 factors which may support it over the medium term.
Neeraj, give us a sense about a couple of these other names, the real estate stocks. Now, there is talk that maybe there'll be some money that will shift from equities to fixed income, maybe another asset class like real estate as well. What's your sense? I wanted first, what's your take on that? And if you had to play it via the stock market, then would you play it via the listed names, the housing finance names, or the ancillary companies, the pipes, the cement names?
I think I would go with the ancillary names right now. See, real estate, we saw a good move. See, I'm from North, I'm from Delhi, so I can talk about the Delhi market. We saw a good move happening in places like Gurgaon, which is, developing, real developing place where the prices really went up, shot up a lot. But now lately we've seen that there's some stagnation which has happened after the prices which become very expensive. So there may be some small softness or a consolidation there. I'm not saying it is over for them. I think after the consolidation again, real estate should do very well. But because this initial move that we saw, interest rates going up, and some stabilization happening in the prices. So the ancillary names like you mentioned, cement, and other companies like whether it's the tile manufacturer or the other home improvement companies, there was this margin pressure which was coming because of high commodity prices. So which may ease. Even for cement companies, the logistic prices come down. So logistics, the raw material pressure will come down for these companies. So there you may see margin improvement happening this quarter and next quarter. So I would rather go with those kind of companies.
Okay, thanks a lot, Neeraj, for joining in, and Happy New Year to you and your team. In case we don't meet again, have a great Christmas and New Year. And
thank you so much.
Hopefully we'll speak in 2023. Thanks for joining in. Well, after delivering healthy profits during the pandemic lockdown, tech giants have lost trillions of dollars in market cap in the big tech sell-off of 2022. Not just that, recession fears have led to massive layoffs across the industry. As we wind down on 2022, Rima recaps the brutal year that was for the tech sector.
It's been a brutal year for tech giants around the world. Apple stock is down about 18% so far, and it is one of the better performers. Facebook owner Meta, Amazon, Netflix, Google's parent company Alphabet have all fared far worse, with Meta plunging nearly 65% this year. The other tech giants of Nasdaq, chip giant Nvidia, Elon Musk's Tesla, are also down massively so far in 2022. What's hurting? Rising interest rates, macroeconomic uncertainty, and global pressures. Recession worries are hurting Amazon and Apple, and concerns about a strategy shift. For example, Meta going all in on augmented and virtual reality, Netflix embracing advertising for the first time ever is also hurting. Let's talk about what happened back home in India. Now, 2022 has marked a sharp decline in stock prices of Indian IT giants as they moved in step with their global counterparts. As things currently stand, this year could be the worst year for Nifty IT since 2008, when the index was down close to 55%. The reason? PED rating, as global interest rates went up, and then there were some EPS cuts as growth forecasts moderated. TCS is now trading at a forward multiple of 25-26 times. The peak was 32 times, and the list goes on, with Infi, HCL all trading at a much lower valuations compared to their peak. The worry is also about what next year holds. Analysts estimate that growth will slow down further. Nomura is saying the US dollar revenue growth to slow down to 8% next year versus 12.7% in FY23 for the big companies. The next big story of 2022 were the tech layoffs. Now, according to a layoff tracking website, layoffs.fyi, data as of mid-December shows nearly 1,000 tech companies have laid off close to 1.5 lakh employees. And that includes biggies like Meta, Google, Amazon. They've laid off thousands of employees. And the question is, will this belt tightening continue next year? And the answer is probably yes. Many companies which have not announced their job cuts yet are likely to do so next year. HP is looking to pull back on its workforce. Reports suggest Google is looking to axe about 10,000 employees next year. And here we're only talking about the multinational tech giants. There are so many smaller startup companies where we are seeing some big job cuts too. But the biggest newsmaker of the year for me is Apple, which moved its iPhone 14 production to India. Now, Apple has been assembling smartphones in India since 2017. But up until this year, Apple used the manufacturing facilities in India to assemble the older generation handsets, the legacy models. This year, 2022, was the first time Apple produced the latest smartphones. They produced the phones as the same year as its release. Just a few months of lag compared to China. And the story is we've just gotten started. According to JP Morgan, every fourth iPhone will be made in India by 2025. What's the driver of this big shift? China unrest, reduce your dependency on China, and an affirmation of India's PLI scheme. According to India Cellular and Electronics Association, India is likely to export handsets worth $9 billion in FY23 versus $5.8 billion in FY22, a whopping jump of 55%. And this is the big question as we step into 2023. Can India become the new smartphone manufacturing factory for the world?
Welcome back. Well, we're almost into the final minute of trade itself, but a couple of stocks have moved, particularly in the last hour. You have Amy Organics. Yet again, that stock now is spiking up to the high point of the day. So keep an eye out on that one. One of the few winners actually in the last hour or so. But to wind things down, well, it was a weak trading session. The Nifty ends closer around that 18,200 odd mark. And from the frontline index itself, well, the day belonged to the pharma names. Just take a look at that. The top gainers on the Nifty included the likes of Cipla, Divi's Laboratory. You had diagnostic as well as hospital-related stocks that did pretty well. Apollo Hospitals was up in trade, Sun Pharma as well as Dr. Reddy's. And the top 5 gainers on the Nifty itself were from either the hospital chains or from the pharma pack itself. On the flip side, well, you had a couple of these Adani Group stocks that came in for a knock. Adani Enterprises last couple of days moved with good amount of momentum. Today it did come in for some selling. Adani Ports as well was down closer around 3%. And the banking names, well, they had not a great session at all. IndusInd Bank was one of the top losers, was down closer around 2.5%. ICICI Bank as well as Axis Bank, both of them down closer around 2% apiece. And you had Kotak Mahindra Bank as well, that was down nearly around 1.8%. From the broader markets as well, just a couple of names that deserve special mention. NBCC, India Bulls Housing Finance, both of them got smacked. Attempts were being made to pull back, but those two got knocked. But Mangalam, plenty of winners as well from the broader markets.
Plenty of winners from the broader markets. You spoke about the top gainers on the Nifty being from the pharmaceutical space. I'm looking at the top 8 gainers on the F&O space today, and all of them belong to either pharma or healthcare. We had Glenmark, Metropolis, Alembic, Granules, we had Biocon, Lupin, Abbott. All of them were among the top gainers in the broader markets. But as we speak, the weakness was quite visible. We had nearly 2,500 stocks end on the losing side, with just around 420 stocks which ended on the gaining side. So all in all, it was a weak day for the market breadth. And among the losers, we also had a lot of these COVID unlocked trades. We had Indian Hotels losing, we had Delta Corp and PVR among Trent as well, which was weak. The Nifty, for the record books, closes above that 18,200 mark. It was indeed a weak, volatile day. With that, we wrap up on this edition of Closing Bell, but you don't go anywhere. Our brand new show, Winning Mindset, comes up next.